welcome all. It's a pleasure to be here. For you to know, it's my first time in a row, and the more I come, the more I enjoyed it. So welcome. It's a pleasure to be here. So I think we are going to talk about exits. I think we'll have a great session in this sense. I usually say that on the one hand, exits are like the end of a new journey because they do bring capital to companies and they do bring liquidity to shareholders. So it's a life-changing moment. So that is the first reason why it's so relevant to talk about it. And the second reason is because I think we could not have a better panel than with my dear friends. Okay, so you have Jesus, you have Herwig, you have Pablo. Each one of them can present yourselves, please. Jesus.
Go. Thank you. I'm Jesus González. I'm the head of the junior markets in BME. BME is Bolsas y Mercados Españoles, Spanish stock exchanges. And I work there since I was a boy. So I have been very lucky to see everything what happens, and my focus completely in startups, scale-ups, small companies that join and that IPO and try to raise money and of course grow within the market.
Herwig.
Thank you. I'm Herwig, co-founder and chairman of i5 Invest. We essentially help tech founders to sell their company as being sometimes the end of a long cycle, sometimes the start of something new. We accompany our clients along the whole journey, which is more than just the typical due diligence, exit, M&A process. There's much more to it. Happy to tell you more in the end. What we want to achieve is that the company gets acquired, not just sold. We are 120 people across Europe and the United States, and looking forward to a really good discussion. It's a very exciting topic I'm really passionate about because it's a culmination point where a lot of things materialize of a long journey.
Good. So I'm Pablo. I'm in the corporate venture capital of Telefónica. I guess you know Telefónica, Spanish telco with operations in Brazil, UK, Germany, and Spain, obviously. We have a corporate venture capital that is driven by two kind of goals, so strategic goals and financial goals. So financial goals, like a normal VC, and sorry, Joao, that's why I always say that my job is much difficult than yours, because I have two kind of goals. So DPI, TVPI, IRR. So it means that we are worried about exits, obviously. And the second kind of goals are strategic goals. So a number of startups invested working with Telefónica, volume of the deals that Telefónica does with Telefónica. So in a nutshell, we have invested in more than 1,000 companies. We have provided to Telefónica from these startups more than 1 billion since we are measuring this in 2018. And yeah, we have a very good average, more than the average return financial.
Okay. So in my case, I am a venture capital working for a Portuguese firm for the last 15 years. So let's dive into the discussion. And I would bet that if there are founders here, which I think there are, everyone sometime in its life thought about doing the typical IPO or public offering. But if you see the numbers, the reality is that most of the deals, typically around 85%, most of the exits usually are tied to trade sales, to secondary operations. So you have a pretty diverse range of different exit options, public, private, secondaries, or whatever. And I think you can have here different views. And if we can start by that, so kind of some trends that you see on these different exit routes, differences between Europe, US. Jesus, starting by you, please.
Yeah, okay. Well, in our market, particularly this micro caps market, we've been quite hectic in the last 5 years, but still too small for the need of the ecosystem. Last year, for example, we IPO 14 companies, almost 20 in 2024. We've been 7 up to year to date. But still is very small. The average size of a company is not so big. It's maybe from 40 to 60 million as a median. But for us, the most important thing is not exactly the IPO or the exit, but the journey of the company to grow from the IPO and beyond. This is the idea. I mean, so many times, particularly in this kind of events, people are very obsessed with the I have to exit, that means I have to sell, and that's it. I mean, and it is exactly the company that in the public market we do not need. We need companies that obviously you can sell some shares or whatever, but you have to put your eyes in the long term and try to build up the company. And this is where you can find a real success if you go out in the stock exchange. It is obvious that if you compare Europe with the United States, we are very little, slow, too much regulated, but still there are many people that love to make business in Europe. And I think our mission is try to keep those companies well served in terms of capital, but in many other things, not just capital. No? We'll see.
Okay. Thank you for sharing that more public-oriented and public offering, and more on the private side, on the trade sales and secondaries. Both Pablo and Eric, please.
Yeah.
What can you a little bit on your take on that and the trends?
So there are huge differences between US and Europe, and it doesn't make sense to compare too much because you cannot really roll over the system to the other one. And there are different things that are true and not true. Like I do believe the US is heavily regulated, and Europe it's sometimes is using it an excuse that everything is so regulated, so difficult, and tax system is not aligned. That's also true. In California, taxes are really high. It's super regulated, and still they have a lot of companies there. And mostly they have super liquid markets in terms of IPO markets, providing exits, creating serial founders that again reinvest and create this kind of ecosystem flywheel effect. And whenever you have that, you've got really successful examples, and you have that in Europe as well, and you have that in Spain as well. So it wouldn't be, in the end, you just need to double down, focus on that. If you sell a company, you have to really think that probably you're just 1 out of 5 who actually made it that far. So selling your company, you've been part of the really successful journey. That's really important. And overall, what we've seen on top of strategic acquirers, that used to be the biggest acquirers on the trade sales side, we've seen quite a vibrant private equity ecosystem. That was always there in the US, like really, really large ones and to smaller ones. That kind of is growing, and there in Europe as well, where we have like quite sizable European private equity funds that pursue buy and build or roll-up strategies, try to form larger groups, which might eventually go public. And we also see that's actually interesting that some people probably don't know is that a lot of US private equity funds are really eager to invest in Europe because we still have talent, we still have great market, we still can build companies. We can build companies with far less capital than a US company. And the other thing is there's a little bit of price arbitrage as well. So the European company being the same to US one tends to be like a little cheaper. So a lot of money is actually flowing from the US to Europe. And that's also the last factor. I don't know. I don't want to go down the rabbit hole into a political discussion, but a lot of funds are diverting money into Europe because it's perceived to be more stable from a political perspective.
That capital intensive or not being so by European companies is usually something that the US like to. And more on the corporate side, probably if you can.
It's difficult to add friends and trends, but I think each of the products and each of the targets has different angles, right, and different framework, right. So in Telefónica we have both companies in product companies, so 20 several years ago, iOS, SaluSpot, Athens, so fine. In Telefónica also we have bought a lot of fiber companies and radio access company, the last one yesterday, or yesterday were announced. Also we have bought companies during the last 5 years in the aggregators company, services company in the B2B side, so in cybersecurity, AI, data, and cloud. And each one has different trends, right? So, but if you want to see the global picture of tech M&A is that it's more than 1 trillion this year, 1.1 globally, but the most important figure is that it's 60% higher than year on year, right? So we are living good times for tech M&A. And if you focus the attention on the activity in AI, cybersecurity, and connectivity, that is those are the areas where Telefónica has the eye on, the growth is much higher, right? So, but the most important thing is that the trends that are behind this is that within the venture capital, so the large mega deals are increasing 50% year on year, and the GVs, like for example, 2 or 3 years ago, the OpenAI thing with Microsoft or NVIDIA with ASML, and some others are living the golden times, right? So they have tailwinds. Tech M&A has a lot of tailwinds. We're sure this is going to survive. This is going to be at the same growth, at the same pace during the next 2-3 years. And because the trends that are behind this, or the tailwinds that are behind this growth, is that we are very worried about the sovereignty in several parts of the world, in Europe particularly. AI corporates, we need AI, we need to buy AI companies to complete the full tech stack of our companies, and that's it. So, and just one last thing, this is about the scale as well, right? So it is obvious that bigger companies has bigger multiples. So if you want to be a bigger company, you need to buy companies, right?
And I think you have saw here the position, so different angles to achieve an exit and different perspectives of an exit, right? Because we always have the perspective of the founders and the existing shareholders, which is typically to really exit, but there are some cases, like Jesus said, that exit is just the new beginning, right? So, and the founders in some of the cases would need to go further. And just so, there are many different rules, and if you allow me, I would pick up on a word by Herwick, which said something like, and in the VC community we say this a lot, that companies typically are not acquired, they are sold. Which means that typically they have to, at some point in time, start to discussing what is an exit, and they need to position themselves towards an exit. So if you can share with us a little bit of your feelings, of your understanding of, if it's on the metric side, if it's on the synergy, so what should a company do to become a little bit more exitable, if the word exists? Probably, Pablo, starting by you in this case.
Yeah, as I said, every time we do an investment in a company, from the CVC perspective, from the corporate venture capital perspective, which is different than the M&A perspective, we see different kind of opportunities, right? So an opportunity that we only need to learn about something. This is the typical opportunity for a corporate venture capital. Second, a tactic partnership. So just for distributing the product of the company or something like this. This is the typical as well deal of a corporate venture capital. But if you want to go beyond and you have a real appetite on the startup that you are about to invest, we have two different angles to measure this. One is, as I said, the financial and the strategic. If we go deeper on the financial, for us is obvious. It's about revenues consolidation. So growth is important, but it's about EBITDA. It's about bottom line. Obviously, we are not going to invest. If we want to invest in a company because it's a target for a potential acquisition, for us it's obviously important that they have some kind of path to profitability in the next 2-3 years, because otherwise they are going to bother our P&L, right, and our balance. So first, EBITDA or path to profitability in the next 2-3 years. Revenues. The second thing is very important as well. So we are not risk averse because we have a venture capital that have invested in more than 1,000 companies, but we need to control the investments that we do. And thirdly, it's also about the velocity to integrate the companies in Telefónica. And that's why sometimes it's better to acquire channels, to invest in channels, to invest in services company instead product companies that are more difficult to integrate.
To integrate in the structure, right? And Harry, your perspective here?
To add what you've said, on top of like numbers and financial performance, you need to have an answer what AI is going to do to your business. That's super important. Ideally, you have an AI mode, you have defensibility, and you can really explain that, how you deal with it now in a year, 2 or 3 years, and how that might show or not show in numbers. So a lot of people look at customer churn now, which was not such a big topic 2 or 3 years ago, as long as you were growing, but now customer churn is really important. And how sticky are your customers? If you don't have a ready answer for that, you risk of not even having a transaction, actually, because people are really, they want to understand that really in deep. And companies we've seen that actually can explain it is like vertical software, mission critical software, a niche, or hardware is actually getting more interesting now. More and more funds are looking into hardware because it's perceived to be more defensible against AI, or managed services, which is like not a typical SaaS thing, but you manage and you service your customer and it's stickier, so that's actually good defense against AI. So those are the things I would just add with what you've said. And to the original part of the question, I think you want your company to be acquired. It's fully true. If that's the case, if the other side asks you, can I buy you? It's a completely different ballgame, obviously, right? Because you can say, no, I never want to sell, and no, I love my company so much, I know what they're going to do with it, and blah, blah, blah. So you can really create a story that you don't want to give it away, which makes it even more interesting. And I think you can do it yourself, you can do it with us, you can engineer that story. So the easiest way is basically go out, map your ecosystem of potential acquirers, partners, customers, like really be thorough about it, and start conversations with them early on. Don't do it when you want to sell in 3 months, then it's too late. But try to build the relationships over 12 months, 24 months, so that they know you, that they have you on the radar, that you're on the strategy slide of the strategy person.
Towards
exactly. And then basically some of them will figure out themselves, that's a cool company, I want to know more. And then the whole snowball effect starts. And then you actually get acquired, although the hidden intention was to sell.
Okay. It's typically a journey, so our experience also says that. So typically a journey in which you build relations, you build product, business, and somehow you then may end up in an exit. And in your case, in particular, with the programs that you have more toward the scale-ups, what would be the criteria, or what can you share, Jesus?
Yeah, of course. Well, I may say it's a kind of hybrid between private market and public market. I mean, kind of investors willing to invest in these companies and the BME growth or BME scale up tend to understand that companies should not be as structured as companies willing to tap the IBEX 35 or the main market. Okay, so they allow, for example, even negative EBITDA as far as the plan is to reach the break even next year. And it's something really feasible. Okay, but in general terms, companies, at least in our experience, tend to go in phases as far as they try to not raise too much money in the first step, but to face this raising of money or exiting in the next 2, 3, 4 years. Okay, and this is where it works. And moreover, if you combine this with building up, acquiring another companies with the advantage of being a listed company, and so paying at least in part with shares. Okay, so to sum up, I would say you need a business plan where investors can rely on that, because you are not exiting the company, or at least completely exiting the company, but you have to be there, and you do, and you will be examined the next year, and the second year, and the fourth year, and so on. And if things go the right way, you can do a lot of things, and you will raise money year after year. If not, well, you will get into trouble. But basically, the metrics are very similar.
I think this is what Jesus said is really, I cannot further emphasize it, because for examples that we had seen is that typically a company and with a shareholding structure with VCs, and we do look for an exit, but the fact is that sometimes we are not fully aware that there is a journey after, either for a company, either for a PE group, either for the public market with the company being traded, which means that we need to think that there needs to be a business plan after that. So even though we are exiting the company, we are selling our shares, the next one would be buying the shares probably, and would have to have his own an exit strategy. So this is typically what happens, and I think you touched it very, very well. Just approaching the end, and a little bit of a more provocative question is that sometimes we are always discussing that exit is very strategic, it's on the top of the mind of the founders at some point in time, but is it always good to be like that? So can sometimes that a company is too focused on an exit be a problem? And sometimes exit versus growth, it might not work together. Harry, starting by you.
I think you should never start a company to eventually sell it. I think that's the worst idea, because most likely it's not going to work out. Because the odds are really against it. And if you manage to grow a great company that somebody is so interested to acquire, that's great. But don't bet on it, and don't have it too much in the back of your head. Although as soon as you raise funds, the exit option is there, because any investor needs to make some money. But even then, things can fail. And I really think, try to build something, try to find something, it sounds really stupid, but it's really true. Try to build something that you really like, that you really want to work on like 24 hours a day, then you're really good at it, and then you're better than the competitors, because they also build something they like, presumably. And if a great company comes out of that, and you can sell it, great, and then it's perfect. But don't try to reverse engineer an exit. It's not going to work. And you make the wrong decisions, really. You start to think about too much in current terms. You stop investing into the future. You focus too early on profitability. You try to time things you cannot time, because there must be a willing buyer as well. So we try to not work with founders that only say, I built a company for exit. There are cases, and they worked. Serial founders might be able to do that, but actually really strongly recommend against it.
Okay.
Yeah.
One of you, please. Jesus.
No, I was telling to say that I completely agree. I mean, you should focus in growing your company and making it more efficient, and focusing the bottom line. And then could be a good idea, because people will tell you. I think that if the founders are very willing to sell, I mean, obviously the buyers will perceive it.
Mm-hmm.
I'm going to put some people in the conversation, so I'm not going to be as nice as you. But one of the questions that we as a CVC ask in the IC, well, it's supposed to ask the question before the IC to prepare the IC, right? But one of the typical questions is, how do you envision the exit of your company? And they have to have an answer for this. I'm going to sell this company. I'm going to do an IPO. I'm going to sell the company to a private equity, to a company like Telefónica. I mean, for us as a VC, we like to invest in companies with plans. Obviously, the holding period is 7 years, more or less, 6 years, 7 years. For us, it's 7 years, the holding period in which we have a shares of a company, and we have more than 1,000, so it's a good average. And we like companies with a plan. We like entrepreneurs with a plan. We like entrepreneurs that if they say, no, we are going to build this for selling the company in 2 years, in 8 years, in 5 years, they need to put the attention on the different phases on their growth. So in the seed stages, they don't want to give rights that they don't need to give to, like preferred rights, drag along, co-sale, these kind of things. But if you don't mind to sell if you are more worried about other things and about buy companies with a product that the customers want, obviously you have to do all the things. But it's not a matter to choose. You have to do the two things, right? Yeah. So you have to, if you think you are going to sell a company to CrowdStrike, to Telefonica, to Meta, to whatever, you need to focus the attention on building something like this, right?
Yeah, I think there is a balance here. Sorry, I think there's clearly a balance. So we also have this perspective. So if you are raising, you will be a VC-backed company. An exit has to occur in the future. So you need to prepare for that. What Herwig, I think, and Jesus was also saying is that before the exit, you really need to build the company. And building the company is, you need to increase the top line, make the company profitable at some point in time, usually more in these last few years than in the past years, but those are the things that we need to manage. So I think we still have time for one question, one or two, one at least, so we'll need questions, please. But it has to be fast, so. One, please. We are here.
No.
Everything ends.
No one has one. Okay, we have there. Thank you. Thank you so much. You can raise and speak.
Hi, hello. How do you handle the regret? You know, whether you decide to sell or not, the money maybe sometimes is good, sometimes not. After a while, it's kind of natural for a lot of people to have some kind of regret. You know, I could have sold for more. I could have waited. What if I kept going? This mindset is very present. You probably know what I'm talking about. If you have something to say about this.
If I understand correctly, I think regretting things from hindsight, the only thing you can really avoid is basically increase your optionality and make the most educated decision at this point in time, that you really choose the right path. Eventually, maybe there was a better path, but you will not regret it because you did the best you can back in that time with the information you had available. I think it's the only way to solve it.
I should say in the public market, regrets come from a contradictory mistake, which is if your valuation is too high at the very beginning, then you will struggle with sluggish quotation year after year, and that's really bad. I mean, it's much better the contrary. It's regrets. I sold it a bit cheap, but then things are going, and the next time will be better.
Okay.
Well, I think it's a case by case, right? It depends on the LP's pressure you have. It depends on the finance team of Telefonica pressure as well. So it's a lot of things, and it's difficult to say one. It's a business.
Thank you. That's all.